Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Middleby Corporation Annual Report. The Middleby Corporation offers a wide range of businesses and services across various industries. In the commercial food service sector, the company provides equipment such as ovens, ranges, fryers, steam cooking systems, heated cabinets, charbroilers, toasters, griddles, mixers, refrigerators, ice machines, frozen dessert equipment, coffee and beverage dispensing systems, craft brewing equipment, and IoT solutions. In addition to commercial food service equipment, the Middleby Corporation also offers food processing equipment, including batch ovens, baking and proofing ovens, conveyor belt ovens, frying and thermal processing systems, tumblers, grinders, slicers, reduction and emulsion systems, battering, breading and seeding equipment, water cutting systems, food presses, suspension, filling and depositing solutions, forming equipment, automated washing systems, auto-guided vehicles, food safety handling, freezing, defrosting, and packaging equipment. The company also caters to the residential kitchen market with a range of products such as cookers, stoves, cooktops, microwaves, ovens, refrigerators, dishwashers, under-counter refrigeration, wine cellars, ice machines, beer dispensers, mixers, rotisseries, and outdoor cooking equipment. With its extensive product portfolio, the Middleby Corporation has established itself as a leading provider of commercial restaurant, food processing, and residential kitchen equipment worldwide. The stock price of Middleby Corp has remained relatively stable over the past year, despite several significant news events. In February 2026, the company reported strong financial results for the fourth quarter and full fiscal year 2025, surpassing its guidance for revenue, adjusted EBITDA, and adjusted EPS. This was followed by a slight pre-market dip of 0.02% in the stock price. The announcement to spin off the food processing business into a separate public company was also met with positive reactions from analysts, resulting in a 5% increase in the stock price on March 1, 2026. The successful completion of the sale of a 51% stake in its residential kitchen business to an affiliate of 26 North Partners LP generated approximately $565 million in cash proceeds, which Middleby intended to use for share repurchases. These news events did not result in a significant stock price decrease exceeding -1.16%, indicating that investors have confidence in the company's future prospects. The stability in the stock price can be attributed to the company's strong financial performance, strategic initiatives, and positive reactions from analysts. Overall, Middleby Corp's stock price has remained resilient despite various news events, suggesting a stable outlook for the company. The Middleby Corporation maintains a market capitalization of $8 billion, broadly in line with the industry peer group. The Middleby Corporation trades at a lower price-to-earnings ratio of 23 times and a lower price-to-book ratio of 2.81 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth is primarily driven by the development of new restaurant chain concepts and expansion into non-traditional locations. The increasing demand for automated equipment, addressing labor issues, and innovative solutions with integrated IoT platforms also contribute to revenue growth. Additionally, growing global demand for food processing equipment and packaging, as well as a backlog of orders, are significant drivers of revenue growth. On the other hand, revenue decline is primarily driven by raw material price increases, lower than expected revenue performance in the current year, and forecasted revenues indicating potential decline. Contingent consideration, associated with acquisitions and changes in fair value of contingent consideration liabilities also contribute to revenue decline. Furthermore, foreign exchange derivative contracts, warranty claims paid, research and development costs, and cash paid for interest are other drivers of revenue decline. Market conditions such as high interest rates and international tariffs, as well as macroeconomic conditions, including challenging housing market conditions and higher carrying costs of inventory levels in the channel, also impact revenue growth or decline. The net income of the company experienced a significant decline between 2024 and 2025. The decrease was substantial, with a drop of $706,164, which translates to an 11% reduction in net income from 2024 to 2025. This decline can be attributed to various factors, including non-cash impairments that negatively impacted the company's bottom line. The profit margins also suffered a decline during this period, dropping from 39.7% in 2024 to 39.1% in 2025. Furthermore, the operating profit margin decreased from 12.7% in 2024 to 11.5% in 2025. The decrease in profit margins can be attributed to interest rate fluctuations and potential future impairments. The payments of contingent consideration in 2025 also contributed to the decline in net income by $22.6 million. This highlights the impact of one-time expenses on the company's financial performance. Overall, the decline in net income and profit margins suggests that the company faced significant challenges during this period, which may have been due to increased expenses, decreased revenue, or other business operations. The company is indeed generating positive operating cash flow. This can be seen in the various financial statements provided, which consistently show a net cash provided by operating activities. On page 27, it is stated that the company generated $564.6 million in net cash from operating activities after accounting for changes in assets and liabilities. This trend continues throughout the document, with similar figures reported on pages 42 and 46. The latter specifically notes an operating cash flow of $370.1 million for the year 2025. Furthermore, page 81 confirms that the company's operating cash flow is a substantial $565 million, which can be attributed to net cash proceeds. Overall, these financial statements demonstrate that the company is successfully generating positive operating cash flow, indicating a strong and stable financial position. The company's debt level has undergone significant changes over the past few years. According to the extracted summaries, the total debt decreased by 8.3% from $2.4 billion to $2.2 billion between two specific time periods. Additionally, long-term debt saw a decrease of 9.3%, while the principal amount of convertible notes was reduced from $747,499 to $0. Furthermore, the current portion of long-term debt and long-term debt itself decreased by substantial amounts. In terms of interest expenses, there has been a notable decline. The company's interest expense rate dropped from 3.7% in 2023 to 2.9% in 2025, representing a decrease of 22.6%. Moreover, the actual interest expenses have also decreased significantly, with a reduction from $121.1 million to $93.4 million, and even resulting in a loss of -$277,731 in 2025. Overall, these changes indicate that the company has made efforts to reduce its debt level and interest expenses over time. The performance of various segments and regions within a company has been analyzed based on extracted summaries. On the positive side, the commercial foodservice equipment group saw significant growth in both net sales and segment-adjusted EBITDA, reaching $850 million and $171 million respectively. In Europe, Italy and Germany were notable performers, with acquisitions in Parma and Darmstadt contributing positively to their respective regions. These successes demonstrate the company's ability to integrate new businesses effectively. However, not all segments fared as well. The residential kitchen equipment group struggled, leading to discontinued operations due to poor performance. The food processing business also faced challenges, although a plan is in place to separate it through a spin-off. International operations were another area of concern, hindered by regulatory and geopolitical issues. The corporate and other segment lacked data on net sales, making it difficult to assess its performance. Overall, the company's results highlight areas for improvement, particularly in international markets and certain business segments. Management is optimistic about the company's outlook, citing a growing demand for food service equipment driven by new restaurant concepts, international expansion, and replacement of existing equipment. They believe that automated equipment addressing labor issues will provide customers with a significant return on investment. To stay competitive, management plans to invest in research and development to bring innovative products to market. The company is also focused on improving profitability and efficiency through better process control, packaging designs, and other solutions. Additionally, they are committed to reducing the company's environmental impact by providing sustainable solutions to customers. Management has identified strategic acquisitions and investments as a key strategy for achieving its objectives, but acknowledges that intense competition in the industry may pose a challenge. The company has made several significant acquisitions and divestitures over the past few years. In terms of acquisitions, one notable example is the purchase of all capital stock of J.C. Ford on November 1, 2024. On the other hand, the company has also undergone several divestitures. One major transaction was the sale of the Residential Kitchen Equipment Group to an affiliate of 26 North Partners LP for $885 million on February 2, 2026. Additionally, the company sold a 51% stake in its residential kitchen business to the same affiliate. Furthermore, the company has proposed a spin-off of its food processing business through a separation transaction, targeting completion in Q1 2026. This move is expected to further streamline the company's operations and focus on core businesses. The company's financial activities have been transparent in their reports. One notable aspect is that they have not paid dividends to their shareholders. This decision suggests a focus on reinvesting profits within the business rather than distributing them to investors. On the other hand, the company has indeed bought back shares from the market. The exact number of shares purchased and the remaining authorized shares are documented in page 21 of their reports. The company is facing significant concerns regarding its inventory management, which could potentially lead to supply chain disruptions. One major issue is the heightened inventory levels, partly due to decreased availability of resources and inflationary costs. This has resulted in a substantial increase in raw materials and parts inventory by $1.25 billion. Furthermore, the company has written down excess inventory to its estimated net realizable value, indicating that it may not be able to sell these items at their current market price. Additionally, reserves for excess and obsolete inventories have been mentioned, suggesting that the company is anticipating potential losses due to inventory buildup. The non-cash impairment charge of $131.8 million recorded on page 83 also underscores the severity of this issue. The increase in finished goods inventory by only $15.04 million is a relatively small amount compared to the significant rise in raw materials and parts inventory, which may indicate that the company's production capacity is not keeping pace with demand. Overall, these concerns suggest that the company needs to reassess its inventory management strategies to mitigate potential supply chain disruptions and minimize losses due to excess or obsolete inventory. That concludes the financial summary for the Middleby Corporation. Feel free to comment below, and I will be happy to answer them when possible.